protecting Main Street from Wall Street. It's time for Money Unleashed with Eric Johnson and Kyle Allyn.
You have to have a plan where you know if the market's going to go up, what happens next. And you also have to have a plan where if it doesn't go the way you think, you know what you're going to do.
It's time to put you back in control of your money.
I'm not trying to predict the weather, which is kind of what we're talking about, right? It's predicting the stock market. I'm trying to build a better boat.
This is Money Unleashed with Eric Johnson and Kyle Allyn.
Welcome to the Money Unleashed podcast, powered by the Hoffman Financial Group. I'm Eric Johnson. Joining me, as always, is Kyle Allyn. We're the vice presidents of Hoffman Financial Group. You can catch new episodes of the podcast each Friday, so make sure you're subscribed wherever you get your podcast. Let's jump into the show. Kyle, we're going to talk about something that's virtually impossible. Time in the market. You can't do it. You never know what's going to happen next, especially with this current administration that's doing things on a daily basis. You know, one day you might feel like the world's ending, and the next day everything looks like sunshine lollipops. Time in the market, it's a very difficult discussion when we have people coming in because they're constantly wanting you to time it. They want you to be a day trader. They want you to be in. They want to be out. Like, here's a great example. Like, obviously, we just witnessed, I guess, a black swan event, if you will, with these tariffs, the tariff tantrum that was happening for the past couple of months. Well, I couldn't tell you how many people are coming in and are like, get me out, get me out, get me out. And I'm like, wait a second. This is not COVID. We did not shut the world down for 4 months. This is not systemic risk like 2008. This is simply just policy change. This is all fixable, and it will be fixed. And what happens is the markets, come right back. So imagine if you got out at the bottom April 8th before the announcement of the reciprocal tariffs being paused for 90 days. You would have guaranteed a loss, and then you would have bought back into the same positions again on the way back up at a premium, which means you basically just lost twice. So trying to get out on the way down is silly. We call it catching a falling knife. We don't want to do that. And a lot of people kind of forget the fact that sometimes holding can be more beneficial than buying and selling and moving things around all the time. We talk about timing quite a bit, and you don't want your short-term problems to mess up your long-term goals. That's what I like to remind everybody out there. Now, yes, there are opportunities to make adjustments to create a better outcome in the future when the markets are down. However, being out of the market totally is a big mistake, Kyle, isn't it?
It is. So I want to tell you a story. I did this on our YouTube channel a long time ago. So if you ever go watch our YouTube channel, you'll see me talking about the worst investor ever.
Okay.
All right. So this is Bob. Bob was the worst investor ever. So Bob was in a scenario where every single time when he invested, the next day the market blew up.
Okay.
All right. So Bob sets out. Here he is. He's going to decide he's going to invest. So in 1970, he begins his job and he's 22 years old. He's saving. He's planning. He's saving $2,000 a year in the 70s, and he's going to bump that up by $2,000 each decade until he can retire at 65 at the end of 2013. Right? So Bob's basically a normal person. He's saying, hey, I can't save a lot of money, but I can save. So I'll save my little $2,000 a year, and then I'm going to drop it in the market. Well, let me talk to you about when Bob dropped it in. Bob would put it in his bank account, and he decided to invest in December of 1972, in August of 1987, in December of 1999, and in October of 2007.
That's really bad timing.
That's right. So he had invested $184,000. The first time he put it in the market went down 48%. The second time he invested, it went down 34%. The third time he invested, it went down 49%. And the very last time he invested his money, it went down 52%.
So this guy's not getting invited to a lot of birthday parties.
No way.
Nope.
But he had one skill. Once he committed to something, he just said, well, I'll stay the course. Okay. So in Bob's scenario, he invested $184,000, as we said, but Bob became a millionaire at $1.1 million and was able to retire. Now, here's what's amazing. Had Bob just had the fortitude to be in the market, it's a game changer. So I want to tell you another idea here. If you invested $10,000 in 2003 and you just let it sit until 2022, right? So 20 years or 7,300 days. If you invested all 7,300 days, you would have $64,844.
So that went up 640%.
Woo, buddy.
If you just left it in there.
Yeah, once again, small investment, nice return.
Okay.
If you missed the 50 best days, just 50 days out of 7,300 days, your $64,000 investment becomes $5,746.
Okay, that's terrible.
So not only do you have to be in the market, you have to be in the market just a few days. And the ability to catch those 50 days out of 7,300 is nearly impossible.
Yeah.
So I can repeat this until the cows come home. I can say this over and over again. I'm never going to be able to quell the energy and the greed that exists within people that are basically trying to gamble and time the market. I hear you. But if you could see it, it's time in the market.
Not timing it.
Not timing the market.
100%.
We have to get to a place where we understand that this tool known as equities, you need time in those equities because they'll move really slow or nothing at all for a very long time. And then all at once, big returns. And if you're not in those positions in that moment, you will miss out.
You're going to miss out on either a percentage of it or the whole thing.
Totally.
Like Bob did. And now the good news is that he
stuck to it.
He stuck to it. That's fine. But I want to really stress this to everybody out there because we have a lot of people come in here and I tell them first thing, I'm like, listen, I'm not a day trader. Don't call me at 3:59 on Friday asking to buy whatever the latest, greatest one-arm bandit is. We're going to invest long-term for you. Now, can we tweak it here and there? Yeah. And another thing I'd like to point out, a lot of the people that come in there, they're watching financial news, which I think is good because it's a good way to educate yourself. But what you're finding out is that nobody on the television, they're never all out of the market, Kyle. Do they trim positions? Like Warren Buffett's never I'm all in cash. And it's okay to trim positions, and that's reasonable. But getting all in cash, big mistake. You're basically trying to day trade it and time it, which is virtually impossible. And even the best advisors have a hard time doing that. And I got news for you. You never get out at the top, you never get in at the bottom because we're not Nostradamus. Nobody is. You don't know what's going to be coming down the pike that's going to force the markets down, and you definitely no idea what announcements are going to be made to make it go back up too. So it's difficult, right? Because everybody wants to be rich yesterday, right? They want to make a ton of money in 5 minutes, and they want to put $10,000 in. They want to turn to $10 million in 5 days. I get that, but it's not realistic.
And I love the quote. So you brought up Warren Buffett. I saw this the other day. It said, chains of habit are too light to be felt until they're too heavy to be broken.
Mm-hmm.
I want to say this again. Chains of habit are too light to be felt until they're too heavy to be broken. And that is investing. You feel like you're doing nothing. You're just putting this little piece in, nothing's happening.
Yep.
But then all of a sudden, at the end of that process, 10 years in, 15 years in, 20 years in, the compound effect of those investments is enormous.
Well, that's why people love their 401k so much, because you're getting forced to add to everything every couple of weeks. It's called dollar cost averaging. And if you look at this, when the market goes down, people don't freak out because it's in a 401k. They can't touch that money, right? So they're buying into it when it goes low. And then when it goes back up, they're super happy again. It's the same concept that Warren Buffett does, right? Like he trims on the way up and he buys on the way down. And I know it sounds super easy, but it's not, because it's an emotional game. Money is an emotional game. We get hired to take the emotion out of it for you, right?
Talk to me about that. So you just introduced a concept that I want the public to think about for a second, because we talk about protection rotation, which is saying that we are moving investments. And so there's a little bit of a contradiction sounding in that we say, hey, we do a protection rotation strategy,
Sure.
But we're also saying don't time the market. So walk me through, right? The market's up, you're going to do some trimming, or the market's down, you're going to do some repositioning. I want you to talk to the clients about what that actually means, because it kind of sounds like, if I'm just listening to the show, that you're saying that you time the market. You're jumping in and out. So I want you to walk me through the idea of trimming the positions and also rebalancing.
Well, that's great. So great question. So yes, we believe in active management here at Hoffman Financial Group, which means we want to see you quarterly, right? We want to see our clients every quarter. So if it does call for any trims or adjustments, you guys are up to date on what we're thinking and how we're going to manage your portfolio. So let's start with the growth piece. So let's say you've got $1 million and it is in a growth portfolio, and you've got $500,000 that's in a defensive portion of your portfolio. And your $1 million goes up 30%. You just made $300,000. Well, okay, that's great. What I typically find, and what's so difficult about being a fiduciary advisor, is when the market's going up, no one wants to stop the up, right? And when it goes down, no one wants to buy because they're afraid it's going to keep going down. If you make 30% off $1 million, you want to trim those positions and put it in your pocket, right? Like you don't want massive exposure. It's not going to go up forever. So especially if you're getting closer to retirement, you do want to trim some of those gains.
So elaborate on the word for us, right? The word trim. So when you decide, hey, I'm going to trim, what does execution look like? Are you selling all? Are you selling half? What does that look like for you?
Well, what I would tell you is this. Let's say you made $300,000, right? And it's long-term capital gains. I would argue trimming 150 to 200 of it and repositioning it in something that's defensive, that's making you a reasonable rate of return, anywhere from 4 to 8%, that's not a bad idea, because when the market does go down, and it will, nothing goes up straight to the sun, then you can take from the defensive positions and put them back in very similarly to how you're working your 401k or how Warren Buffett does. Trim on the way up and buy on the way down. It's about making sure that you have the dry powder in your portfolio to take advantage of those downs. That's another thing that I see, Kyle, is people come in and they are fully invested. They've got no cash. They've got nothing that they can put into it when it goes down. And that's why people hate red days. The people who tend to love red days, i.e. me, I love them. I know it sounds weird because everyone's like, you love red days? Yeah, I love red days because I'm backing up the truck. April 8th, April 7th, I was backing up the truck for my own personal portfolio because a bounce is going to come, right? And so it's just about making sure that you're positioned properly. Yeah, we're not going to sit there and get you all into cash, but you can't be greedy. There's sayings in our world like, bears make money, bulls make money, and hogs get slaughtered.
That's right.
So it's about not being greedy, understanding you made a reasonable rate of return, making sure you bank those gains and keep them protected. So when the next time the market does fluctuate down, now you have an ability and a way to take that money out and put it back in so you can make more money on the way back up. That's all it is. That's all it is. But you got to have a plan for that, right? We talk about the 5 Ps. Proper planning prevents poor performance. If you're just sitting there waiting for the market to go up and down so you can make a decision, that's going to make it really difficult, right? Like having the disciplines and a plan put together in place is the only true way that you can identify when to trim and when to get back in the bottom. So, yeah, I'm not trying to say that we're day traders, and I'm not trying to say that we don't do anything. We are going to be trimming portfolios here and there, but it has to be appropriate, and you don't want to let the greed bug get you, right? Because 2 things move people in this world. It's greed and it's fear. I love the greed part because that's how you make people a lot of money. Like fear can be, it can blind you, right, into doing things that you don't want to do, which is going to result in bad results in your portfolio. But having a plan put into place, knowing that if the market goes up, we're going to do this. And if the market goes down, we're going to do this. It creates a ton more clarity for you as an investor. And it creates a much better view of how you're supposed to make money in the future. And it takes the emotion out of it too. Like if you know that A happens and we got B, and if C happens, we got D. That's the best way I can explain it and try to do it and blimp.
Well, and here's the power. We're going to meet with you on a quarterly basis. So a lot of times when you're meeting with a team, meeting with an advisor, sitting down with someone talking about Wall Street, they talk to you once a year.
Yeah.
So the ability to grasp what they're doing is very limited. So one of the powerful things that we're able to do is sit down with our clients on repeat. And so a lot of times with clients, I'm just showing them again and again and again what we're doing. Once they see that rhythm, that discipline, and they talk through it 3 times, 4 times, 6 times, 12 times, they get it and they go, okay, I can sleep well at night. I see exactly what Kyle and his team is doing. I can see exactly what the Hoffman team is about. When we get to this position, they're trimming and protecting. When we get to this position, they're putting it back into the marketplace.
What we want you to get out of this conversation is you need one of these plans put into place so you can maximize your portfolio. The best way to do that is to give us a call. There is no cost and no obligation. 404-640-5511. That's 404-640-5511. Or you can find us online at unleashyourmoney.com.
Eric Johnson and Kyle Allyn are investment advisor representatives of Brookstone Wealth Advisors, LLC, a registered investment advisor and affiliate of Brookstone Capital Management, LLC. BWA and Hoffman Financial Group are affiliated under common ownership. Registered investment advisors and investment advisor representatives act as fiduciaries for all of our investment management clients. We have an obligation to act in the best interest of our clients and to make full disclosures of any conflicts of interest. Please refer to our firm brochure, the ADV2A, page 4, for additional information. The Hoffman Financial Group and WSB are not affiliated. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. This information should not be considered tax or legal advice. Individuals should consult with a professional specializing in the field of tax, legal, accounting, or investments regarding the applicability of this information for their situation. Any client experiences discussed during the show are unique to that client. They are not meant to imply or suggest you will experience the same results. Past performance is not a guarantee of future results. Investments will fluctuate and when redeemed may be worth more or less than when originally invested. Any comments regarding safe and secure products and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims paying ability of the issuing company and are not offered by Brookstone. Index or fixed annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract. Please refer to our firm brochure, the ADV2A Item 4, for additional information. Hoffman Financial Group is not affiliated with or endorsed by the Social Security Administration or any other government agency. Insurance licensed in Georgia, number 163546.